So let's get started talking about cryptocurrency before we can talk about trading cryptocurrency on our platform. And to do this, I found a great presentation done by CNBC and the Sunday Morning Supplement, and I've edited it down, and I'm going to share that with you right now, and then we'll go on talking a little bit more about cryptocurrency. So that gave us a quick 3-minute explanation about all the aspects of Bitcoin and digital currency. But the fact is, a lot of us just don't understand what this is. And the fact is, it is a lot more complex and complicated than everybody wants to make it sound. Like in that little presentation, it sounded like it was really easy to buy Bitcoin, to get a hold of it, to make profit. Well, the fact is, every time you look in the news, there's another scam. there's another hack. There's another problem. Because when you buy Bitcoin or any of these altcoins, they're digital currency that has to be stored. It's not something you're going into your bank account, you're putting in your safe deposit box. It's not like you're buying gold bullion or buying gold Krugerrands and putting them in your safe deposit box. You're just putting all of this money, and you're having to find out and understand what an exchange is, how to store them on wallets, where to keep them safe, and of course, hopefully that nobody hacks anybody. So those are some of the problems or some of the complexities in just trying to understand this and how to buy that on an exchange. It's not like you're just going and saying, I want 2 Bitcoins and I'll sell them to, the price is moving continuously. So let's try to start out with a real brief explanation of what a digital currency is. And the way I explain it is I remember way back when stores didn't have gift cards. They had gift certificates. And you go in the store at Christmas time and you didn't know what to buy your grandkids, or you didn't know what to buy, somebody else. And you say, you know what, give me a gift certificate. And the store would hand you this, say, $50 gift certificate. You hand them $50. Now, there was no computer involved because they didn't have any record keeping. They take the $50 and this certificate would say it's valued at $50. It would be signed and stamped and everything else. And you could only take it back to that store where you bought it and use it. And the fact is, if you'd only spend $47 or $50, those days they'd hand you back $3 because there was no way to keep a record on those gift certificates. But as technology moved forward, we started being able to, the stores, and this is again before we have today's gift card, they started offering store-bought gift cards that had a number on them. And they were plastic cards, and they would put it in the computer when you'd buy it, and you'd want $50 on it. They type in $50, and as long as you had that card and brought it in the store, it would keep deducting down until there was no $50 left because it was in the store's computer network. Nobody else's, but the store's computer network. From there, we move one step farther because we were able to put these on the Visa and MasterCard network. And so you go in the store and you buy the $50 gift certificate in the store. And a lot of times, and still today, it's still only good at that store. But you could go online using Visa and MasterCard and check down your balance to see what was going on. Or you could buy one online and transfer it, send it to your friend across country online. It started moving up. Now today, we have Visa and MasterCard gift cards you can buy in any store. Send them to your friends, use them. You could use it yourself a little bit, then give it to your kid to use a little bit. You can give it to the next door neighbor. And the fact is, it would just keep taking down until there was no balance there. Some of them allow you to recharge them. But the fact is, those gift cards have nobody's name on them. They're not attached to anybody, but they have a value that can be used virtually anywhere. Now, the difference is they use the Visa and MasterCard network. Well, if you think about the Visa and MasterCard network being like the blockchain, not the same technology, but you need some type of technology that tracks all of this stuff. Now, the Visa and MasterCard network are private, and the stuff going through there is private. The blockchain is public, and every transaction is verified and then placed on that blockchain network. But because nothing is tied back to you, it's just like the gift card. It's just a Visa number 5247974, and that card can be handed off to the next person, reused by the person down the street. Okay, but nobody has any idea who's using it for what. And that's the anonymous part of cryptocurrency. So cryptocurrency is a form of digital money that is designed to be secure and in many cases anonymous. It is a currency associated with the internet that uses cryptography, the process of converting legible information into an almost uncrackable code to transfer or make purchases. Now, the biggest difference is the value. Now, we say this digital currency has a value, and the value is assigned by people. So as long as somebody's willing to buy it at a price and somebody's willing to sell it at a price, that is the value. Because it's not a state-backed currency, it's not tied to interest rates, its rate is not set by a central bank, it's not regulated, but it is still some type of currency or some type of asset because it does have value. Now, once you have buyers and sellers, once you have a growth of users, once you have volatility, and once you have a network that will process all this, in comes speculators. Just like when you watch oil and gold prices, especially oil prices, there are so many speculators in that market. It's buying and selling, buying and selling, buying and selling. It's got really nothing to do with the real live oil market out there. Because there's these middlemen, these buyers and sellers who are constantly making profit on price movement. Now, the thing with, and I'm going to use Bitcoin as the main example. Bitcoin has a limited amount of Bitcoins. So therefore, we have a known supply. As demand increases, what happens? Just like in every other asset, demand increases on a set supply, the price goes up. Why does demand increase in cryptocurrency? It's not demand increasing in oil because Saudi Arabia or OPEC cut back or increased production, and the U.S. manufacturing is going up, so we're using more energy and more oil. No, because there is no reality of oil. There is no actual ultimate thing being purchased. Because in the futures market, when you're buying oil and people are speculating in between, ultimately there's physical oil and there's people actually taking delivery of oil. And so the speculators are in between. Bitcoin is not. So what happens is in cryptocurrency, it's the users. And as we get a growth in users, this creates demand on a limited supply and pushes the value up or down. Why, you ask? Well, 5 or 6 years ago, when there was very few people into Bitcoin and buying Bitcoin, there wasn't much demand. So if you had a Bitcoin and wanted to sell it, you'd put it on an exchange and you'd have to wait till somebody was to come up with some price that's willing. Somebody's willing to buy it at that price. Well, as all of these hipsters and all these cool people decide they wanted to get involved in Bitcoin, not because they wanted to trade it, not because they thought it was the thing of the future. It was all about the social media aspect. Being able to tell your other hipster friend, I'm cool, I have a Bitcoin account, and I bought some Bitcoins. Okay. Well, all of a sudden, last year, I'm hearing grandparents are buying Bitcoins for their grandchildren. Well, when all of these people want to buy these Bitcoins, the price goes up. Demand increases. So we have supply and demand moving up and down. Now, the fact is, when we have supply and demand moving up and down, we create volatility. Now, how do you capitalize on this? Well, you could physically buy the Bitcoins, go online to go to an exchange, buy the Bitcoins, you create a wallet, put them in your wallet and sit on them, pay all the fees to buy them, and have to figure out and understand what exchanges are and wallets are and how to keep them safe. Or you can trade with your CFD provider, which in this case is ETX. Okay. Because here we can trade CFDs that are just based on the movement or the value of the cryptocurrency using your plain regular account, not having to store the Bitcoins, and you can take advantage of buying or selling, shorting or longing Bitcoins. So again, let me pop up a little presentation I have for you on understanding a CFD on Bitcoin, and then we're going to go over to the platform and actually take a look at this. Okay. So let's first understand what a crypto CFD is. CFD stands for contract for difference. This is almost everything you trade on the ETX platform. It's classed as a derivative, but because ETX is a fully regulated provider, so are the cryptocurrency CFDs, because you're not actually buying or selling the underlying asset. You're buying and selling a contract based on value. And therefore, since ETX is a regulated provider, all of your trades in cryptocurrency on the platform are regulated also. And your funds are just stored in the whatever fund or whatever currency you have your account in, and you can trade it, open and close a position, and you don't have to worry about wallets and exchanges and everything else. So CFDs have been around for a long time and are a common investment product. Now, it's only been recently that ETX started offering CFDs for several of the major cryptocurrencies. Now, as you know, ETX is, like I said, a regulated provider. They're also a very cautious provider because they want to make sure what they're offering to their traders are the best choices that keep their traders from getting in too much trouble. So we don't offer all of the odd altcoins. We offer the top 5 cryptocurrencies. Okay. Now, cryptocurrencies allow you to trade movements in the price of cryptocurrency without owning or purchasing the cryptocurrency. This is useful because you don't have to worry about security issues regarding cryptocurrency, such as encrypting your wallet, downloading a backup, etc. When trading CFDs, there is no need to purchase the underlying asset. This makes investing in cryptocurrency safer for those worried about the security of cryptocurrency and those who do not want to set up wallets and actually purchase the cryptocurrency. Traders can speculate and make money on large price movements without needing to know how to acquire or store cryptocurrency securely. Also, another benefit is you can also, and only in CFDs, can you sell cryptocurrency and buy back later. So you make advantage of the fall in the market and the climb in the market. So in the last 24 hours, you've seen cryptocurrency, or since Monday morning, cryptocurrency take a huge nosedive. Well, if you were aware of the markets, you could have traded Bitcoin to go down and you could have made yourself a good deal of profit this week. So trading currency directly means you would have to sign up to exchanges or purchase cryptocurrency at a markup from the market price. Trading CFDs means you can buy or sell at the market price and gain more from large swings in either directions. If you believe that the price of the cryptocurrency will drop, you're able to short the cryptocurrency by opening a sell or short trade. This is something that you can't do when you actually hold actual cryptocurrency. As a trader, this gives you much more flexibility when it comes to your trading strategy. Also, generally, execution speed is extremely fast on a CFD, while buying and selling the actual can take sometimes 48 hours. Okay. Can take hunting through exchanges to find a coin at the price you're willing to buy or sell, especially when markets are moving very, very quickly and you actually want to sell your physical cryptocurrency. It could take a while to dispose of it. So as a trader, this means you can, trading CFDs, you can react quickly to market movements. Also, on our platform, cryptocurrencies are leveraged. Now, leverage is controlled by the FCA, and it's fairly minimal. The FCA has just reduced the cryptocurrency leverage, but you still get the advantage of leveraging up your trades. So putting down a small amount of capital to tie up a bigger market share. Skilled traders will be able to use this to their advantage. Now remember, you still have the same risk you have trading all CFDs. Any bit of potential profit is equal with the potential loss or down. Okay, so don't think it's just, everybody's going to get rich trading cryptocurrency. Remember, you always need to use risk management strategies and money management strategies, and to be aware that your risk is as great as your possible reward. So to give you an example, let's say, for example, you anticipate that cryptocurrency or Bitcoin would fall in value compared to the US dollar. Let's assume that ETX is quoting the foreign exchange for Bitcoin USD at a selling of 3607 and buying at 3609. In other words, a cryptocurrency is worth a little bit more than $3,600. You could open a short position selling 10 CFDs at 3607. That means you're tying up $36,000 of asset. The price falls, and once the quoted buying price has dropped from 3609 to below 36073, you have covered the spread and you start making profits, and you can close your trade, your sell trade, at any time that you're in profit. Many people who are interested in trading CFDs trading cryptocurrencies find CFDs are much easier than dealing directly with the currency. Now, what coins can you trade with ETX? And what coins do make a difference? Of course, we offer Bitcoin, which is the largest by market cap and the oldest of all the cryptocurrencies, being around since 2009. Now, Bitcoin's made a lot of news lately about his new fork and all the stuff that's going on it. Okay, and has offered lots of trading opportunities because of these new forks and new debates going on between Bitcoin. There is no central authority, as servers verify transactions, and instead the legitimacy of payment is determined by the decentralized network itself. Okay, is some of the biggest advantages of Bitcoin. Bottom line, Bitcoin is the original cryptocurrency with the most liquidity and the significant network effects. It also has brand name recognition around the world with an 8-year track record, which one thing about trading Bitcoin that helps is it's now been around long enough that we can find support and resistance levels, historic prices, and these coins, all of them, work great with technical analysis. We also offer Bitcoin Cash, which is a fork of the main Bitcoin. It's growing by leaps and bounds. It's only been around since July of 2017. Now, Bitcoin Cash is a peer-to-peer electronic cash for the internet. It is fully decentralized. It's a child of Bitcoin. Now, Bitcoin Cash is the continuation of the Bitcoin project as a peer-to-peer decentralized digital cash. It's the fork in the Bitcoin blockchain ledger with upgraded consensus rules that allow it to grow and scale. So this means that Bitcoin and the blockchain were going in this direction, but continuously developing new technology, new processes. So they forked off to the left, leaving Bitcoin on the path it was going and forking over to where there was newer technology added on. Bitcoin Cash is a fork of the ledger. That means you own the same amount of Bitcoin Cash as you did in Bitcoin. Then we come to Ethereum. Ethereum is quite unique. It is one of the faster growing cryptocurrencies and is an open software platform based on blockchain technology that enables developers to build and deploy centralized applications. Ethereum was never developed as a digital currency. In the Ethereum blockchain, instead of mining for Bitcoins, miners work to earn Ether. Ether is a type of cryptocurrency token that fuels the network. Beyond a tradable currency, Ether is also used by application developers to pay for transaction fees and services on the Ethereum network. Ethereum serves a different purpose than other cryptocurrencies, but it has quickly grown to displace all but Bitcoin in value. From here, we also offer Litecoin. And Litecoin has been around for a while. It's got a smaller market cap, but it's got enough that it's got volatility and liquidity. Litecoin was launched in 2011 as an early alternative to Bitcoin. Around this time, increasingly specialized and expensive hardware was needed to mine Bitcoins, making it hard for regular people to get in on the action. Litecoin's algorithm was an attempt to even the playing field so that anyone with a regular computer could take part in the network. Then we have Ripple. Ripple's a unique little coin. Ripple is a payment network that's essentially used by banks and has been growing by leaps and bounds in acceptance. It's a settlement network. So unlike other cryptocurrencies, Ripple is not about speculation, but strongly focuses on transactional utility. Dozens of banks around the world are looking at Ripple to improve their transactions. But even though it's not about speculation, Ripple goes up and down in value by demand. And the more banks that accept it as part of their network and the more payments are processing, the more of us that want to speculate it, so therefore the price